Welcome to episode 25 of Fundraising Demystified. We are back after an extended holiday break, and I'm excited to introduce our first guest of 2024, Ali Ansari, CEO and founder of Micro1.ai, a platform to hire and pre-vet software engineers that has recently raised a rolling pre-seed of $3.3 million from Dream Ventures and Jason Calacanis, with his most recent valuation being at $30 million. Ali shares his story of how important it was to connect with other founders from peer groups to help him get warm introductions to the investors that got him his first few checks, why he did a rolling pre-seed raise, and how he focused on building a relationship with founders instead of just pitching them, and how he was able to reposition his agency to be a tech company to attract outside funding. There's a lot in this episode to learn. And as a reminder, to get notified of our weekly podcasts and newsletters, be sure to subscribe at join.thunder.vc. Again, that's join.thunder.vc. Well, let's go ahead and get started with the show. Hey everyone, welcome back. You got Jason Kirby here, founder and managing director of thunder.vc, welcoming Ali Ansari to the show today, founder and CEO of Micro1. Welcome to the show, Ali.
Thank you, Jason. Thanks for having me.
No, I'm really excited to have you on today. I think you have a really unique story that I think will resonate with a lot of founders in the terms of what you did for Micro1, from kind of repositioning you guys as a tech company to make sure you close your capital round. But before I ramble on about that, why don't you tell the audience a little bit about you and Micro1?
Yeah, absolutely. I studied computer science at Berkeley, started a dev agency when I was a freshman there. And as I was building the dev agency, I quickly realized that there's a need for building in-house engineering teams for companies versus working with them as sort of a agency project-based engagement. And so I experimented with that model on the side, which is helping companies hire and manage pre-vetted software engineers. And that experiment was called Micro1. Really quickly, I realized that model is much more scalable. And frankly, Micro1 outgrew the agency very quickly. So I decided to kind of merge the two together, focus on the core offering of Micro1, which is to help companies build world-class in-house engineering teams. And then my third year at Berkeley, I was studying math and computer science, but I decided to drop math so I can graduate 1 year early and focus fully on Micro1. And then shortly after graduation, we ended up raising a pre-seed round of funding, which was led by JCal and Dream Ventures.
No, that's awesome. And, the fact you have, the infamous JCal on the cap table. I'm a huge fan of the All-In Pod. So let's talk about this a little bit. So when I first heard of you guys, the first thing that comes to mind is staffing agency. And that's, first thing that comes to VC minds as non-venture backable. How did you go about convincing, people like Jason Calacanis and Dream Ventures to believe in you and to believe that you're much more than just another staffing agency?
Yeah, so there's a couple of things there. And that was actually one of the things that we were struggling with in the early days of trying to raise. People would just look at us as a staffing agency and we didn't have the right narrative built around why we're very different. Basically, the difference is that we're productizing a staffing agency, essentially. You can think of it as a marketplace of vetted engineers where companies can really quickly hire world-class talent. The first part is, that sort of mechanism to productize it, which is you can essentially go through a very easy process, tell us requirements, see profiles, request interview, and then, hire that engineer and then manage that engagement on the dashboard as well. So manage basically means, it's not the DevOps side of things. It's more like global HR management where you can give a raise, give a bonus, track hours, and, all those things. But the second part, which is super important, is we built out a tool called GPT vetting, which is basically a pre-screening tool for screening technical talent at scale. So that's really what made the difference is, we were conveying to investors that our secret sauce in the long run is going to be, we're going to get thousands of applications each month of great engineering profiles, and we're going to screen through them at a large scale very quickly using GPT vetting. And so when we build out that tool, the vision for productizing a quote unquote staffing agency became very clear to investors, and the sort of perception changed around it.
No, and that's a good way to think about it in terms of productizing staffing, because I think no one argues with the fact that staffing can be very profitable. It's just, typically linear scale and there's, lower margins, but, staffing, it's big budgets in most cases. At what stage was the business in terms of clients and revenue when you were able to kind of get that first term sheet from Jason Calacanis?
Yeah, so Actually, the first term sheet wasn't from JCal. We had a bit of a sort of odd way to raise a pre-seed, which is, I call it like a rolling pre-seed, basically. So the way that we did it is we had Joshua Browder and Corey Levy as the first two investors. They each put in 110K. And then after that, we grew for a couple of months, and then we went out to actually raise a full pre-seed. And actually, the initial post-money valuation we started at was a $7 million cap, and we got a bunch of angels to join at that 7 cap. We actually also got the whole Micro1 team to put in small checks as well. And then after that 7 cap, we then grew again for about a month or two, and then we raised the cap again to 14, and that's when JCal came in and sort of led that. And then at the 14, we got a few 100,000 more from other investors. JCal, of course, being the majority investor. We wrapped that up in I believe in June. The terms were set a couple of months back. JCal took a couple of months for due diligence, and then a few months after that, in October, actually very recently, we got another $1.3 million check from Dream Ventures. We actually had wrapped up the round. We did, $2 million pre-seed, wrapped it up. We wasn't expecting any more checks. We got some interest from VCs, but we were just, respectfully declining. But Dream Ventures made us a good offer in terms of value adds as well as valuation. They upped the cap from 14 million to 30 million. And the 30 million, we almost had doubled in size in terms of revenue since the terms were set for when JCal set the terms at 14 million. It wasn't exactly double, it was close to double. So the valuation was a little bit more than double. So it was a bit of a premium, but it wasn't just an arbitrary increase from 14 to 30. But yeah, they put in 1.3 million at 30. So we had basically an oversubscribed round, and it came out to a total of 3.3 million. And all of it wasn't at the 30 million or at the 14 million. It was a rolling pre-seed throughout.
I really want to talk about this a little bit more in what you call the rolling safe, which is, I would say, more normal than most founders like to admit. And as much as everyone likes to think that they can just go out and get all the money they need in one fell swoop at a pre-seed stage, it's actually less likely to happen. And so I guess kind of walk us through the timeline. So you brought in those first couple angels. You mentioned Corey Levy and another. At what point did they jump on board? Was there already revenue? Was there already traction at this point when you got those first angel checks?
So there was a bit of revenue, very small, almost nothing. And I actually still had the agency, so I was kind of working on two things. And Joshua, I had a call with Josh. We had like a 15-minute call, and then like right after the call, he sent me an offer. Of course, we did some due diligence, and then he invested right away. And at that point, we didn't have any product or anything. Like, it was like super scrappy, like bunch of like type forms basically. But we did have a little bit of revenue. And then once we wrapped those up, a couple of months after that, where I stopped working on the agency, I just had Micro1 as the only company I was focused on. We had a product to show as well as more revenue. That's when we went out and raised, started raising the pre-seed.
How'd you get in front of Joshua and those investors?
So my friend Mark from Hypercard, shout out to Hypercard, he introduced me to Corey, and Corey runs Z Fellows. I'm pretty sure you probably are aware of Corey. Z Fellows is an incredible community, by the way, of amazing founders. I was in a Z Fellows cohort, and then it's a week basically accelerator where you meet a bunch of co-founders and meet Corey and some mentors. After that, Corey introduced me to Josh, which is a mentor at Z Fellows and founder of Do Not Pay. And then I had a call with Josh for 15 minutes, and that's when and Corey and Josh actually decided to invest together.
No, that's awesome. And that's something I just want to highlight for other founders in terms of like the best introduction you can get to, investors are from other qualified, vetted founders. And it seems like you followed that path to the T there. And moving on to getting introduced to the next round of investors. So Jason Kalkanis and the others said, like, ultimately, how did you get in front of them, and what led them to investing? And were you working directly with Jason or more so his team?
Before Jason, Joshua and Corey introduced me to a bunch of investors. I met Ryan, I met Andrew, Kim, from people from General Catalyst, and many VCs, and got a lot of directions. And of course, some said yes. Most of them were angels putting in like 50 to 100K checks. And then after, so we raised close to $1 million with just those angel checks through introductions from Joshua and Corey. After that is when I met JCal through an introduction. I first worked with his team. Andre on his team. That he was my main POC. The whole team at launch, by the way, is super great and easy to work with. They do have a very long due diligence process, which I respect, but they're very easy to work with. And then the final meeting was with JCal. And frankly, I didn't think the meeting went too well with JCal. I was like, okay, like I don't think they're going to invest, but I got an offer the week after, and they wanted to invest at a nice valuation. So we took that.
No, that's awesome. That's good to hear. And I guess what were some of the experiences you had in terms of the no's that you got? Like, in terms of all the investors that you pitched, you obviously got a couple of yeses that, secured the round and you're out to the races. But, what was it like dealing with the no's, and how many no's were you dealing with?
Good amount of no's. I mean, I probably met at least 60, 70 investors, probably more, somewhere around there. And, a portion of them said yes, but the no's were each time were sort of like general reason, really no feedback. Sometimes the feedback would be around the sort of staffing agency thing that we talked about. That became much less when we introduced GPT vetting. I think one thing I would have done earlier on to perhaps close a little bit faster is I would have spent more time on the pitch, but more so the story around the pitch and like the narrative I want to build for why I'm working on this and what the $10 billion, $100 billion vision is. I didn't have enough of that. And I realized after that, of course, showing what you're building now, like the current state of the product is important, but really showing what you believe the product will be in 5 years is also extremely important. You have to get investors to get very excited for a $10 billion, $100 billion possible outcome versus, what is the current state. So the initial iteration of my pitch was very much what the product is now. And when I showed Josh the pitch, he was like, scrap this, like show what the product is going to be in 3 years and like talk about the company as if you're already there. So basically conveying the vision in much more detail throughout the pitch. And so I iterated many, many times throughout the race. Like I probably changed the pitch maybe like 15 times. But what I would have done, obviously the iteration is good, but I think if I spent more time in the beginning, just really building a nice story, that would have saved some iterations and probably closed around a little bit faster.
But would you be able to have written that perfect story without going through all the no's and the feedback and feedback loops that you had prior?
That's a good point. And yeah, you're right. Probably not. I think it's just part of the game to go through these many feedback loops so that you can iterate. In retrospect, it feels like, oh, maybe I should have just done this in the beginning, but you probably just couldn't do it in the beginning. That's a good point. But I do think one thing is like builders or founders that really are product driven, they kind of hate stuff like pitch decks and spreadsheets, and they just want to build. And I was sort of in the same mindset, and I was like, every time I was spending a minute on the pitch deck, I was like, oh my god, like I shouldn't be doing this. And I think like changing my perception on that a little bit would have helped. I would have just spent a little bit more time in the beginning versus thinking like, oh my god, like let's not do a pitch deck, let's just go back to building. I think like spend a few hours on the pitch deck. It's important.
Yeah, it's a valid struggle that I think a lot of founders deal with. Is just, do I really want to keep doing this dog and pony show? Why don't people just get it? And like, let me just build, give me the money so I can just build.
Yeah.
But it's that, you can't kind of have one without the other, or, chicken and egg kind of problem. But it looks like
Exactly.
you were able to overcome it. So I guess tell us a little bit about where the business is now and how you leverage the capital. Why did you raise as much as you did, and what have you guys done with it to date?
Yeah, so we actually built publicly. So I'll say the numbers here. We're doing a little bit over 400,000 a month in revenue right now. Gross margins are around 40%, a little bit above 40%. That revenue is a combination of our core offering, of course, which is Micro1 Talent, where we help companies hire pre-vetted software engineers. The second part of the revenue is Microlab, which is basically the agency side of our business. And then the third part, which is a very small part of revenue right now, is SaaS, which is GPT vetting. So GPT vetting is, just quick context on GPT vetting. We use it internally for our recruitment team, of course. That was the purpose of building it. But we got a lot of interest from clients wanting to use it. So we decided to actually publish it as a SaaS tool for our clients as well. And so yeah, that's where the business is at right now. We're 25 people. Where the business will be, let's say, 3 years from now, I think is the portion of revenue, which is SaaS, is going to be much, much larger. I think that the path to, let's say $100 million a year is becoming clear. And that path seems to be through GPT vetting and through GPT vetting being used as a SaaS product. And of course, within our Micro1 Talent offering as well, it's sort of a subset of that. But really, the large scale is going to come from companies subscribing, for $500 a month, $1,000 a month, based on the number of reports per month, to GPT vetting itself. So I think that's where we're going. We're talking to a couple of really large enterprise companies right now that are interested in using it, and so I think that's where the focus is going to be. That's certainly where the product focus is. Our product team is the biggest team at Micro1, and basically like 95% of the product efforts right now are on GPT vetting, which helps, of course, our main offering, Micro1 Talent, but also improves the product for our clients that use it as a SaaS product.
And you're public about your numbers, which is awesome. I guess kind of tell me about what does it mean to be building in public, and what's kind of been the pros and cons of that for you?
The first thing that we did, this was about 8 months ago or so, is we made all of our numbers super transparent internally. So, literally every single data point that I see, every single team member sees, and that includes like P&Ls, like how much profit we made, what the gross margins are, every single data point the team sees. And when I was doing that, I asked a couple of my like sort of mentors and founder friends that are more experienced than I am, and almost all of them said like, no, like don't do that. Like it's too much transparency. It's not gonna end up well. And I think in retrospect that was one of the best decisions I've made so far. And it just, the sort of culture of the team has been improved significantly because of it. People work extremely hard, and then they see the outcome of their work each month when we grow. With that, I was thinking about, okay, like maybe I could kind of apply the same sort of philosophy to just everyone on Twitter. Like, why not? I was going back and forth for a couple of months, and I decided that the pros are certainly going to outweigh the cons. There wasn't much cons. The only con that kept coming to mind is like, oh, our competitors going to see our numbers, and really what I came to the conclusion that sure, they're going to see we're growing. Like, what are they going to do with that? I mean, you can't. Maybe they'll see our gross margins and try to like improve theirs or something. But they're gonna do that anyways. So that was sort of the main con that I was thinking about. I was like, you know what, like it doesn't matter. Let's just build in public. So about a month and a half ago, I tweeted out our revenue chart. That was the first tweet of building public. Prior to that, we were doing like product updates and stuff on Twitter. But in terms of the numbers itself, a month and a half ago, and we just off that one tweet, we got like 20 leads, and I was like, all right, this is, we're 100% going to go in like all in with this. And two out of those 20 leads so far have already converted. They're great clients of ours. One of them is Farbuid. He's building something really great, and he's a client of Microlab and Micro1 Talent now. And so I think it gets us leads, it gets us customers, gets us organic demand. It goes very well with the Twitter marketing that we're doing in terms of like actual paid Twitter marketing. We spend about $30K a month on Twitter ads, and my organic Twitter goes very well hand in hand with that. And then the third thing is it builds a lot of trust and authority even before we have sales calls. So our sales team has an easier time talking to clients, because clients look at us as like, a company that they know the CEO of already on Twitter, and they kind of respect us a little bit more, and just it increases conversions overall. So yeah, we're gonna definitely keep going with this building in public.
No, that's impressive, and I think that's exactly a well thought through reason to build in public. I feel when it drives the bottom line business, like the core of the business, I see a lot of reasons to do, and it's also culturally like a lot of founders don't want to do what you want to do because it can create sticky situations internally in terms of people internally knowing all the numbers, or competitors or whatnot. But it looks like you kind of weighed your pros and cons, and you made a decision that works for you, and it's driving a substantial amount of business. But I also kind of want to unpack that you're spending 30 grand on Twitter ads at this stage. Considering you guys, you say pre-seed, but you're at a $400,000 MRR at this point. Now, is it MRR or monthly revenue?
So yeah, it's not all of it is not MRR. A good portion of it, more than 70% of it, approximately more than 70% of it is MRR. But Microlab portion of it is not recurring. So that's total revenue, and then most of it is MRR.
And just for clarity purposes, when you say 400K, is that GMV in a way of like salaries plus your margin, or is it your margin only?
Yeah. So the way I look at it is you can call it GMV, you call it gross revenue, you call it revenue. I just look at it as total top line revenue, and then what is the margins on that revenue. So it's 400K, a little bit more than 400K a month is top line gross revenue, and the gross margins, considering a weighted average of all services, is approximately 40%. So that's in combination of Microlab having 60-70+% gross margins, Talent having 25 to 30, and then of course SaaS having more than 90. The weighted average of all that is the gross margins that we have now.
Did you know that most founders waste days of their lives chasing the wrong investors? Well, as a founder, you know your time is your most valuable resource. Don't waste it on the investors that aren't going to write you a check. Here at Thunder, we built a free tool that identifies exactly which VCs are worth your time to pursue. We score your company against 3,500 VCs and family offices that have been vetted and are actively writing checks into companies like yours. Get your AI recommended list of investors that will look like this absolutely free by creating a free profile at thunder.vc. You can upgrade to premium to download this list, export it to any tool you wish, and get their contact information and access the data on their portfolio companies to map out a path to warm intros and build your founder network. Sign up for free at thunder.vc. Now let's get back to the show.
Gotcha. So, and something I always like to clarify for founders is when they kind of share top line numbers and they're like, oh, like, we have a client doing $1 million a month, but in GMV, and that's, they take a 10%. So technically their net margin is only the 100K. And so investors will quickly look in terms of benchmarking you against other companies, but, still 160, wherever that might be, 150 to 200K is still fantastic numbers, assuming it's continuing to grow. Those are phenomenal numbers to be working from at your stage. So it's still something to be impressed by. But a lot of people try to mask it. They're like, oh, we're doing 400K, but it's actually substantially lower, and more of when you look at the actual operating revenues that you get to work from. But since you have multiple different businesses in that sense, revenue lines, it makes sense to have the blended.
Yeah, and also the way, if we were, let's say, an Upwork, or we had a 10% take rate, certainly call it GMV, and probably we'll talk about the net revenue actually as the key metric, but we're not that. I mean, our take rate is much higher than 10%, and if you take the weighted average of all the margins, it's actually around 40%. So that's why calling it gross revenue, I think, is a little bit more accurate. But really, the way I look at it is sort of arbitrary what you call it. You should look at the revenue and what the gross margins are, and that's where you can determine the health of the company.
Yeah, no, it makes sense. And when it comes to maintaining your relationships with your investors, so you've, doubled and then doubled again, essentially, in less than a year timeline, correct? From when you did the $7 million cap to when you did the 14, and now you did a 30.
Yep.
So I imagine your investors, especially the $7 million cap investors, are very happy. What's kind of been your process of keeping them engaged and informing them of their progress and the fact that you went out and raised additional capital when you originally said you were done?
Yeah, so we do monthly updates for overall company updates where we include, the revenue, the MRR, gross margins, all the data that we have basically. And then in that update, we also have two other categories, which is product and talent. So in product, we talk about, what we've developed and what's coming to be developed in the next sprint. And then in talent, we talk about the core team, if we added anyone new, and sort of we talk about a little bit culture and a few quotes from the team and so forth. So that monthly update, I've been doing it since we got our first check, every single month. Actually, we skipped 1 month. We had a down month, and I was like, you know what, let me just wait until next month. In retrospect, if we have more down months, we're just gonna send an update anyways. But that was a month where I was like, okay, I know for a fact we're gonna jump back from this very well next month, so let me just skip this month's update and do one next month. But other than that, we've been doing monthly updates every single month. And then we also do a product update each month where it's separate than the monthly updates. It's just about the product and everything that we've launched. And actually, we're going live tomorrow with an update with some cool stuff added to GPT vetting. And so there's going to be a product update to investors, customers, and team members probably on Monday. We debug a little bit over the weekend and then send the product update on Monday.
Awesome. And I guess what happened when you skipped that month? Did anyone say anything?
No, not at all. I think people appreciate the fact that we're very diligent with updates, especially at our stage, which is earlier, pretty early stage. And the updates are quite long. There's graphics, a lot of charts and so forth. So every time we send an update, we get, a lot of investors saying hey, great update, which I always appreciate. I think more investors should reply actually to updates. I always love reading what they think, even if it's hey, nice job. Very few do actually, which is kind of odd. But when we didn't send the update, we didn't get anyone asking for it. So yeah, that was nice.
So that's for all the investors listening. Make sure to listen. Respond to your founders. When you put it out and it just kind of goes into what appears to be a black box, I totally feel the pain. especially if there's an ask in there and no one responds at all.
Yeah,
Did
like
anyone do that?
yeah, the last investor update, the ask was to follow me on Twitter because we're doing a building in public, and I only got like 6 followers. I was like, I expected more than that, like 6 new followers, but hey, I appreciate those 6.
You're gonna follow up with each of them one by one, but I looked at my analytics. You didn't click.
Yeah, yeah, I might.
And then you got to get them to repost it, retweet it, re-exit. I guess what do you? I don't know. If you call it retweet.
Yeah, I still call it retweet.
Yeah, exactly.
I love Elon, but retweet it sounds nice.
Exactly. It's like I don't know what to call it anymore. Just repost like you do on LinkedIn. So I think there's some valuable insights, I think, for a lot of founders to think about when they're engaging their investors. And I think it's interesting you chose not to share the update in the down month. But I think it sounds like you've learned moving forward you'll post both the good and the bad. And I think that's something a lot of founders make the mistake of, is they don't come out with the bad, they only project good. And then when things start going bad, I just actually met with a founder I invested in personally not too long ago. Things went south. Business didn't go in the direction it's supposed to. That's what happens in this game. Yeah. But he was so diligent about monthly updates and then just went silent. Like no communication. You're like, something's wrong. But I don't know what is wrong, and I don't know how I can help if I don't know what's going on. So I think it's important to always kind of keep those updates going and flowing, even when they're negative, in the sense that it's a chance to leverage that and ask for help when it can.
Yeah, 100%.
Kind of going back to the raise. So you've been really ramping up, and things have been growing. So you've had a good momentum for you, which is what a lot of VCs want to see. That's why they make a lot of bets. They want to bet on the things that have momentum. I guess. What's your advice to founders to build that momentum when you're raising capital?
Yeah, I think if you don't want to do a rolling pre-seed and you want to just quickly wrap up the round, momentum is going to be incredibly important. And the way that we did it, it was less important just because we had time and we weren't trying to rush it in like a month or 2 months and wrap up the whole round. And we were iteratively increasing the valuation. So I think first thing I'll say here is like, I highly recommend looking into doing a rolling pre-seed because the average valuation of your total round is going to be higher, especially if you're trying to raise like super early on. Why not like keep building and like keep getting more revenue and just increasing valuation every month or two? Of course, you're probably going to spend more time raising in terms of like total hours spent as well as total duration of timeline of the raise. So I would first off, I would say consider that. But if you're going to do a momentum raise and wrap it up in a month or two, which I think every round after pre-seed should be that way. But for that, I would say make sure to have a few really good relationships already. When you announce the raise, you can already get a couple of checks and really sort of start building FOMO. I think a lot of it is just like human psychology. You have to build FOMO within the investor community. Obviously, you got to build FOMO in an organic way because investors can often tell when you're trying to like rush timelines, and that becomes a negative. Like if you say, oh, by the way, we're wrapping up next week, but like in reality, you're not wrapping up next week. Like they're not going to invest if you say stuff like that. And frankly, I did that a couple of times and it didn't work out. So build organic momentum, have a few really good relationships that very likely they're going to invest right away. And yeah, so those are the things that come to mind.
Yeah, let's unpack that a little bit more. Like what are some other things that you kind of learned in your capital raise experience that you felt you didn't do properly or could have done better?
I think one thing would be present the product right away in your pitch. Maybe a quick problem and solution statement, and then just showcase the product. One thing I did later on that really helped is I added a 1-minute Loom video of me just quickly demoing the product. And so people that would look at the deck offline, if they just take a minute to look at that Loom video, which most people actually did, they would have a much better understanding of what we do very quickly. So I highly, highly recommend that. Another thing is, and by the way, like when I met with JCal, like he basically, we skipped introductions. Like we didn't really do any of that. He just said like, show me what you're building. We just jumped into the product itself. Of course, not all investors are like that. You have to kind of gauge the type of conversation the investor wants to have. And that's actually another point of advice I would say is sometimes I tried 2 different methods of conversation with investors. One was running through the pitch deck and then doing questions and answers, after the pitch. The other method was just having a conversation. And I realized instead of like having conviction on one of those things and trying to do that one thing for all investor meetings. Just like gauge either ask them which one do you prefer? Like, should I run through a pitch and then you ask questions, or should we just have a conversation? Or try to gauge it in a more natural way. So once I started doing that at the end, I realized it's sort of a 50-50 split. Some calls I was doing it just conversation. There was no pitch deck pulled up. I was sharing my screen sometimes and show a couple of slides or a couple of things on the product, but it was more so a conversation. But some were more structured, where they wanted to hear the pitch first, like for 6-7 minutes, and then they wanted to ask questions. So like one thing that I kept trying to really heavily optimized for is like, how can I give this investor as much information as possible in 30 minutes? And I realized maybe that's not the best thing to actually optimize for later on. What I started to optimize for is like building more of like an emotional connection by toning down on my personal story a little bit more and like spending more time on that in the beginning, plus simply getting them to understand the product. Like those two things is what I started to optimize for versus like giving them as much information as possible. That's another thing I would say.
Well, I think that's a brilliant revelation for a lot of founders to understand, is they feel they have to just get everything out. Like, we're doing all this amazing stuff, you have to know about all of it. And it's like, what you're really fighting for is another meeting. Like, that first 30 minutes is not to get $1 million check, because that's very unlikely that will happen. But the likeliness of getting another meeting, that's a little bit easier of an ask, easier bit of a lift, and getting them just to get their appetite wet. And which is, do I like you, and do I know what you're doing, and do I believe in what you're doing? Like, those are the real questions you have to get answered in that first meeting. And it sounds like you kind of course corrected to get to that point.
Yeah, exactly. And actually in the beginning, I wouldn't even talk about my personal story. I was like, oh, like let's just jump into to explain the company right away. And when I started talking about my personal story for a few minutes, and it's just like 2-3 minutes of like, I was born in Iran, wasn't really getting along with teachers in elementary, middle school, etc. And like I talked a little bit about the previous companies that I had and how I got a small acquisition on one of them and so forth, and how that transitioned into building Micro1. That I think that part is what really got the second meetings with most investors versus the company itself. And I was completely neglecting that. I was like, in the beginning, I was like, okay, maybe they don't want to hear this. They just want to see if the company is doing well, like what the company is, what the vision is. But really, it's the personal story that matters a lot. So I would spend a lot more time on that. It sounds sort of cliche, like maybe it sounds obvious, but I wasn't doing this in the beginning.
No, I think it's very important to be able to share that personal story and be able to kind of have a conversation and show that, one, you're a human, and two, that that's something that they want to build a relationship with you. Because at the end of the day, especially pre-seed, you're going to be in this relationship for 10 years. It's a total gamble, and maybe this company isn't the one that works. Maybe it's the next one, but because they backed you now, they might get a swing at the next one that could be bigger. So VCs really like the idea of betting early on the right person, and if you don't really get that identity across, it's hard to build that rapport. Going back to what you said earlier in terms of the different pitch styles, so go into a meeting with a pitch deck versus a conversation. Of the investors that invested, which ones preferred which?
Honestly, I don't remember exactly which ones preferred which, but I think it was probably approximately a half split. I think the best way to do it is to simply ask them in the beginning, do you prefer a pitch or do you prefer a conversation? Because it's hard to gauge. Like, you can't really, you can guess, but it's better to just ask. So I started doing that, and it really simplified it. Because a lot of times they do have a pretty strong preference for one or the other. Sometimes they don't, but most of the time they do. So just ask them in the start.
And other funds I got involved, you kind of mentioned with Launch, you were talking to one of his associates first and then got brought into Jason. What was that experience like? Were you talking mostly to analysts and associates first and then moving up your way up the chain? Did you start directly with partners? What was your experience in terms of like who you had that first meeting with, and what was the experience thereafter?
Yeah, so I met Andre first. I think he's an associate, I'm not sure. Met him for about 30 minutes. I believe I went through a sort of a typical pitch with Andre. He's more of a structured and wants to hear the pitch and ask questions. So we did that, and then I met Heidi on the Launch team. I believe she's a partner, and I think for her, I believe it was a conversation. And then for Jason, it was actually quite different than sort of all of them. He just quickly said hi, like 5 seconds, and said, "Show me what you're building." So I didn't even go through a pitch or anything. I literally just logged into the dashboard and showed him what we're building. I went through the flow of what a customer would go through, and then we had a conversation afterwards about the product mainly, but we also talked about his visit, I believe, to to Japan and a few other things.
He made it about himself.
He said, "Do you have any questions?" And I knew a lot about launch already, so I don't have any launch questions. I was like, "Hey, how's Japan?" And so we talked a little bit about that as well.
Smart move, very smart move.
Yeah, he got excited to answer that actually.
Yeah, exactly.
He ended with smiles.
Perfect. Smart move. Yeah, definitely. If you could do anything to kind of toot their horn and kind of use to their ego, it's a smart move because they walk away smiling after the meeting, not so much thinking about analyzing your business. They're more like, oh yeah, he's a guy, I like a guy. So that was incredibly smart. I really enjoyed this conversation in terms of the experience that you shared. It's great to kind of talk to you, especially when you're sharing in public and openly building in public. At this point, what are some final advice that you would give to a founder that is going out for their pre-seed in this market?
I think two things. One is if you know any founders that have raised, ask for their help. Like ask them for specific intros. Maybe hop on a call with them. Tell them about the company a little bit if they don't know much about it, and then ask them if they can make intros. And be sort of direct with it. Founders, for the most part, are very happy to help. And honestly, it's kind of an honor when someone asks for help. Yeah, I like helping other founders. And so I think most founders feel this way. So feel free to ask other founders for help, especially if you're in like communities that like Z Fellows or something where there's a lot of founders that have raised. Just DM people and say, hey, I'm about to raise. Like, can I hop on a phone call with you for 10 minutes, tell you about our product, and maybe get some advice about the raise. And then once you talk to them at the end of the phone call, you can say, hey, by the way, if there's any intros and yeah. So I've had like 3-4 people from Z Fellows reaching out to me. Basically what I just explained, having a 10-minute phone call with them and then making a bunch of intros for them. So like imagine if you do this for like 3-4 founders, you're gonna get many intros. And then intros are like, it's sort of a binary tree of like many more intros that come from intros, especially with the ones that do invest. So look at it that way. I think outbound for VCs, frankly, doesn't work. I did a little bit of that and I got a couple of calls, but actually one of our investors was through me, emailing them or DMing them on Twitter. But I think the effort to reward ratio is like not that good for outbound VCs. And some people like the extreme end of this is that maybe you'll burn some bridges that way. Actually, I don't think that's necessarily true, but some of our investors are saying don't do that because you'll burn some bridges. So yeah, try to get intros and where you should start is of course, like I said, founders. But more importantly, if you can get 1 or 2 people to invest and be sort of your early supporters, like the Corey and Joshes of the world, and give them a discount on the valuation, maybe give them a lower cap, and have them kind of help you raise, that will be super important as well.
No, that's some valuable advice, and I appreciate you sharing that. But I think you also mentioned that there might be some kind of offer that you could present for Micro1 to those listening today. Do you want to share a little bit about that?
Yeah, absolutely. So we have an offer, 240 hours of free software development for any founder listening to this podcast. We'll create a page and we'll maybe link it somewhere. But basically, the way that will work is you'll get 2 weeks free per engineer for up to 3 engineers. And the first week you'll be able to completely try them for free. And if the engagement works out, after the 3rd month, you'll get another week free. So that's for our main Micro1 talent offering. So if you're hiring engineers, feel free to use that. And for GPT vetting, if you want to just use the tool to vet some technical talent, we'll extend the free trial from 1 week to 2 weeks for anyone listening here.
Awesome. No, that's very gracious of you. And we'll make sure to keep the link in the show notes once it goes live. And if anyone has any particular questions, they can always reach out to us at help@thunder.vc if we need to pass it along to you guys. And I guess who would be the best type of founder to take advantage of such an offer?
It's really any founder that is building in-house engineering team. So if you already have a couple of engineers and you're looking to expand your engineering team, then that's perfect. If you're looking to hire a founding engineer, your CTO, you can also use it. So it's really a wide range of companies that are technical, tech companies, and already either have engineering teams or are about to build their engineering team.
Perfect. All right. Well, I appreciate you being on the show, Ali. It's been incredible having you on today, and I look forward to founders and VCs. Good to hear your story.
Thanks for listening to the show today. We hope you learned something valuable, and if you did, be sure to let us know in the comments or by hitting that like button. And if you're a founder looking to raise capital, then join us at thunder.vc. We provide a free tool to help you identify which VC, family offices, or lenders are the best fit for you using our AI. It will save you a ton of time from chasing the wrong investors. And since launching our free tools, founders that have joined our network have gone on to raise over $1 billion in financing. Again, you can find these free tools at thunder.vc. And as a reminder, we release new episodes every week. So stay informed by subscribing to our newsletter at join.thunder.vc. Again, that's join.thunder.vc. And if you or someone you know has recently raised a round and want to share your story, please email me at jason@thunder.vc. And that's our show. We hope you enjoyed it, and we see you next week.